Welcome to the Leaders Insights podcast. Today's episode, Autonomous Accounting Close, what it actually means and where the limits are. Every vendor at every conference this year is selling autonomous close. Half of them can't even define it. So let's start there. What does it actually mean?
It means the monthly accounting close, the process of finalizing your books, matching transactions, booking accruals, producing statements, runs mostly without a human touching each step. The system pulls the data, matches it, flags what's broken, and closes the period. Emphasis on mostly.
Mostly is doing a lot of work in that sentence.
It always is. Look, a traditional close takes a mid-sized company somewhere between 8 and 12 business days. The pitch is you get that to 2 or 3, or even a continuous close, where the books are basically always current. That part is real. The fantasy is a close where nobody looks at anything.
Break it down for someone who's never run a close. Where does the automation actually bite?
Start with reconciliations. That's checking that 2 records of the same thing agree, like your bank statement versus your ledger. Historically, an army of people ticking and tying spreadsheets. Software like Blackline or Flowcast has automated the high-volume, low-judgment matches for years. If 98% of your transactions match cleanly, why have a human stare at them?
So that's step 1. What's step 2?
Transaction coding. When money moves, something has to decide which account it belongs to. Machine learning, pattern recognition trained on your past decisions, now handles the routine ones with a confidence score. A vendor payment that looks like the last 200 vendor payments gets coded automatically. The system says, "I'm 96% sure this is office supplies," and moves on.
And here's my uncomfortable question. What happens with the 4% it's only 60% sure about?
That's the whole game, and it's where the honest vendors and the con artists split. A good system routes the uncertain items to a human with the context attached. A bad one just codes them anyway to hit a nice 97% touchless number in the sales deck. Always ask what the exception rate is and where those exceptions go. If they can't answer, the demo was theater.
So the machine handles the boring, confident majority. Where does it genuinely hit a wall?
Judgment. Real judgment. Think of it like autopilot on a plane. Brilliant at cruising altitude, and you still want a pilot for the landing in a crosswind. Revenue recognition on a weird contract. An impairment estimate, whether a lawsuit needs a reserve. Those aren't pattern-matching problems. They're what does this mean, and what will an auditor and a regulator think problems.
Give me a concrete one.
A customer signs a 3-year deal with a discount tied to hitting usage targets. How much revenue do you book this month? That depends on your estimate of whether they'll hit those targets. A forecast about human behavior. No model closes that for you cleanly, because if it's wrong, a person signs their name to the restatement, not the algorithm.
You're describing accountability more than capability.
That's exactly it. The regulators, the SEC in the states, and auditors under standard practice hold a named human responsible for those numbers. As of 2026, no auditor accepts the model decided as a control. So the human doesn't disappear. The job shifts from doing the reconciliation to reviewing the exceptions and owning the estimates.
Which means the headcount savings pitch is softer than advertised.
The good roles survive, the tedious ones shrink. One benchmark I'd flag carefully, it's from a close software vendor, so discount it, claims teams cut close time by roughly 40%. Plausible for the mechanical steps. It says nothing about the judgment calls, which are the same amount of hard they always were.
So if I'm a CFO who's new to this, what do I actually do Monday morning?
Map your close into 2 buckets, mechanical steps and judgment steps. Reconciliations, matching, routine coding go in mechanical. Automate those first and measure the exception rate obsessively. Leave the judgment steps to your people and stop apologizing for it. Anyone selling you a close with 0 humans is selling you a future restatement with your signature on it.
That's your 5. The full CFO track, structured, no fluff, is at mba-training.com.